Hey everyone. Today we're going to be answering a comment that one of our viewers have left, and they're pretty new to investing, so pretty much they want to figure out where to invest their money. You can see right here it says, being pretty new to it, I really never seen anyone saying that it is wiser to make $1 off of selling 100 shares that went
have more than $100 million. Subscribe to my channel so I can teach you how to make millions.
Let me tell you about my day so far. Coffee in Paris, surfed the Maldives, took a little nap on Mount Kilimanjaro. Oh yeah, and I got digits from this Polish chick in Rio. NBA Finals. And all that was before lunch.
I have more than $100 million. Subscribe to my channel so I can teach you how to make millions.
bought opposed to spending $3,800 on one Bitcoin and waiting, or just that chunk of money, or just that chunk of money. Really, maybe there are videos on it and I just haven't seen them. Keep in mind I'm a noob. Okay, so pretty much this new investor is, I'm guessing they have about, let's say they have $5,000, for easy math. All right. So let's say you have $5,000 and you're trying to figure out where to invest $5,000. Now, everyone is different. Me personally, I would invest $5,000 probably a lot different than how this person would prefer. And the reason I say that is because it seems that this person, their account's name is Newer Account. Newer Account is, it seems like they want something risky, and they want something much riskier than what I would suggest. And that's okay. Investing is all about risk and return. How risky you want to play it for the amount of return. Generally, you want the least riskiest investments with the most possible gains. That's generally what you want. You want the least risk possible with the most potential for gains. I don't have the best writing, so bear with me. But alright, so here I'm going to write risk. The more risk you have, the more reward you should have. Okay? Should. It's not always this way. Just because something is more risky does not necessarily mean it's going to give you the most gains. So over here we'll put less risky. But also there's less reward here. Okay, guys? So, excuse my handwriting. So generally, the more risk you take on, the more reward you're supposed to take on. That's generally how it works. And the less risk, the less reward. Now what would be on this? What would be on this risky side? What kind of what kind of assets, what kind of investments would be on the risk, the higher risk, the higher reward. So, of course, at the high end, we could see Bitcoin is very, very risky. Bitcoin is very risky. It's safer than all the other cryptos. Safer than all the other cryptocurrencies. Ethereum is pretty safe too. Ethereum and Bitcoin seem to be Bitcoin definitely is the safest. So Bitcoin's right now the safest crypto. Ethereum is like, it's like the second safest. And but I consider these also. These are very high risk, and I don't know how much reward there is to Bitcoin and Ethereum because who knows if it's ever going to. But just because I invest 5,000 one way doesn't mean you have to. The difference between a noob investor and a professional investor is that a professional investor, they already have an idea of their own style. They have an idea of their own risk tolerance. And it could be different than another professional, and that's okay. Everyone has different risk and rewards. Everyone has different investing strategies, different investing styles, and you just have to find the one that works best for you. And you could learn from us for sure. Me, I always try to learn from other people, but generally I'm at the stage where I know more than most people. But there's people who know more than me, or they might know something more than me and have a certain advantage over me while I have another advantage over them. Maybe some people have higher risk, but they could also have higher rewards. While some people might not be taking, their investments might be less risky, but they're also getting less rewards. So once Bitcoin goes around 1,800, then you'll see me buying. Right now, I still find it expensive. And if you only have 5,000, you don't want to spend most of it on just Bitcoin. That's risky. Unless you don't mind throwing away the 5,000. Like, it's super risky. This is super risky. Super risky. That's Bitcoin. Bitcoin is super risky. And I don't know how much reward it has. Now, let's talk about the less risky, just so you kind of have an idea of what's less risky. Generally, money is not risky because it's not like Venezuela. Venezuela's money, that's risky. Their money is super risky. It's the most riskiest money. It's probably the most riskiest money out there. And the reason Venezuela's money is one of the riskiest money out there is because they try to print. They printed way too much, and they try to give everyone millions of Venezuelan dollars or whatever. I'm not sure the name of their money, but they try to give everyone millions of it. And when you give everyone millions of it without enough abundance, you can destroy the value of the value of the money. The more money there is, the less rare it becomes, the less value it becomes, the less it's worth. So with cash, here, let's just call this cash right here, which is it's some of the least riskiest investments. So yes, cash is an investment. It's the least riskiest, but it's also the least reward. Actually, as a matter of fact, cash, like pure cash, actually declines about 2 to 3%. So you're in the minus. You're in the minus right here. Every year, when you hold money, you're losing about 2 to 3%. But at least money is very liquid. You can usually use it right away. You can buy cheap investments with it. There's definitely benefits to having cash. So that whole billionaire Warren Buffett holds a lot of cash because he takes some advantage of stocks when stocks go on discount during crashes and stuff. So cash loses about 2 to 3%, but there's a way to beat this 2 to 3%, and that's what everyone should be taking care of, or everyone should be. So your money could hold its value if you put it in a high interest savings with higher than like 3%. Higher than 3%. You definitely want your checking accounts and your saving accounts with more than 3%. All my checking and savings accounts are all higher than 3%. I already spoke about a video about a bank that's offering 4% interest. So if you guys wanna, I'll leave it in the description. And if I forget to leave it in the description, you can find it in my other videos. But there's a 4% interest bank where 4% interest is more than the inflation, so your money would actually hold its value and increase in value a little bit because of the 4% interest. So you're going to be getting paid, and plus they offer a free $50 when you sign up for free. So free $50, that's like a huge bonus right there. So that's a huge reward. That's a big reward. The free $50 is a big reward because it's free. Free is always good. So there's also bonds. Bonds are less risky, less reward. I could talk about that further if you guys want. The gold companies I'm invested in. Smash that subscribe button, hit that like button. So don't forget to subscribe. All right, I'll give you a second. Go subscribe. Click that subscribe button. I'll wait over here. Go click that like button. I'm waiting. Look, hit the like and subscribe. And all right. But anyways, so gold. Gold is what I prefer over bonds. Gold, and also the I prefer the 3% or more than 3% or higher over bonds. But if you want bonds is your style, hey, go for it. These are some of the less risky, less reward. And then there's other stuff, treasuries and other stuff. Um, but generally, that's what I'm thinking about right here. Less risky, less reward. And then right here in the middle, which is a sweet. Actually, I wouldn't even say the middle, but yeah, I would say the sweet spot. Let's call it the sweet spot. Here, since I ran out of space, let's bring this sweet spot right over here, okay? So we could talk about it right here. What does diversification mean? Diversification means you don't want to have all your money in one thing. For example, you don't want to have 100% of your money in bonds. That's stupid. You don't want to have all your money in cash. That's also kind of dumb. You don't want to have all your money. If you have all your money in a high interest savings account, still not the best path, but at least you got a high interest savings account. And if you got a little bit in gold, if you got all your money in gold, that's also a bad idea. You don't want all your money in gold either. Gold, the good thing about gold is gold holds its value, and it'll always be worth something. At least you would think, unless they find a way to make gold from nothing, like turn that's probably, in my opinion, the best. But still, you don't want all your money in stocks either. In my opinion, having all your money in stocks or ETFs or whatever, ETFs are good too. If you have all your money in either ETFs or stocks, that's good. But it's not the best path. You still want diversification. You still there's if you have some money in the high interest savings account, at least an emergency fund. You need at least an emergency fund in a high interest savings account. It's always good to have an emergency fund. It's good to have some cash at hand. Cash will help you. Money inside of the high interest savings account will help you buy cheap stocks. Stocks on discount. Usually stocks on discount are lower risk because it's already discounted. So If you have on the bottom, you can see it says number of stocks. So when you go all the way to the left, it says 1, and when you go all the way up, it shows the chance of reward. But the rewards can still be greater since it's only 15 versus having 500. You know, like the S&P 500, that's 500 companies, the biggest companies. So generally, if you have one stock, it's higher risk. But yeah, there could be a higher reward too. If you pick that, you know, it's just one stock. So if that one stock makes it, then you can make a lot of money. But if that one stock loses, then you lose everything. That's why I would not buy just one stock unless you only have money for one stock. If you have only enough money for just one stock, you know, let's say you only have $50 and the stock is like $50, then yeah, okay, fine, get one. But if you have enough money to get like one of each or something like that, or 10 of each or whatever, 100 of each, and you could get 15 different stocks in each sector. By the way, I have way more than 15 stocks. I have, in my portfolio, I have close to, it's like about 50. It's around 50 stocks that I have. But generally, if you want to be diversified, you need 15 only. And right here you can see that when all the way on the bottom it says 100% bonds. When you look at 100% bonds, you can see the risk. The risk is what, 11? But actually 100% bonds is riskier than if you have 26% stocks and 74% bonds. You can see right there. The risk is only it's less than 11. It's like 10.5. So the risk actually comes down when you have stocks to your portfolio. That's why even if some guy is 100 years old, he should not invest in 100% bonds. Even though bonds are generally less risky, that's dumb. And the reason it's dumb is because you can see it right here. If you have stocks included in your bond portfolio, you would actually decrease risk. But then once you increase stocks, like 50% stocks, 50% bonds, yes, you become more risky. But you can look, the reward becomes greater. When you go all the way to the right, you could see it says maximum risk portfolio, 100% stocks. You can see it's a lot more risky, but there's also a lot more reward. And generally, stocks outperform bonds. So that's another reason why I don't have any bonds in our portfolio. 0 bonds. But that's just me. If you like bonds, then get some bonds. If you want a portfolio that's 26% stocks, 74% bonds, then that's probably one of the least riskiest portfolios you can make. Imagine you have 74% bonds, and then 20%, the 26% stocks are 15 stocks in different sectors. That's a very low risk. Seems pretty low risk to me. you afford one, just get one. But generally, you want at least 15. That's a good starting point. And among this 15, each should have like an equal amount, you know. So I'm not sure what, you know, if you want to do the math, it's something like 100 divided by 15, and then whatever number you get from there, you know, 15, 30, 45, 60, 75, 90, 6. So each stock should have about 6%, a little more than 6% of your maximum portfolio. So you have 15 stocks, each from a different sector, each different sector. So if you have 15 stocks, each from a different sector, and you have about 6%, others could be going up. So sometimes you'll have like some stocks doing really, really good, and you could actually sell those profits and then buy the ones that are cheap. You don't have to sell all the profits, you could just sell some of it if you have like multiple shares. So if one stock is doing good, you can sell a couple of them and then buy the ones that are doing bad, a couple extra. Unless you don't believe in that company anymore and you want to cut your loss short. Because you don't want to keep investing in a company, it's going to keep losing your money and it never goes back up. Now, when I made this video, I was only talking about $5,000. But there's also a way to invest. Generally, the advice I gave in this video applies to any amount up to $250,000. So my advice in this video generally works up to $250,000. Then once you get to the $250,000 mark, there's different rules. Or I shouldn't say different rules. The rules still apply, but I should say extra rule. There's new things that you guys need to worry about. But I don't know if I have anyone on my channel who has 250K or who needs advice on 250K. So if you're one of those guys who you have 250,000 and you're wondering what I mean over here, that there's extra rules for people who have 250,000, then smash that subscribe button and hit that like button and let me know in the comments. Here, I'll wait. Go hit that like button. I'm waiting over here. Go hit that subscribe button. All right, good. Now that we got that out of the way. So if you're interested in knowing what to do once you get 250,000, you know, or if you have 250,000, you're trying to figure out what I mean by extra rules, let me know and I'll let you guys know. And it has to do with insurance. So once you get to the 250,000 mark, there's some insurance. Aspects they need to consider. And what I mean is, because most investing accounts are only about 250K insured, or some are 500,000, right? You got to look at the specifics. So once you get to that mark, you don't want to have that much, like you don't want to have millions in your Robinhood account. I know I have it in mine, but that was just mostly for show. Generally, you don't want to have millions in your Robinhood account because only about, what was it, 250,000 or 500,000? I have to double check on that for you guys, is insured. So when you only have, what, 250,000 or 500,000 or whatever it was, I'm invested in so many accounts, so my bad that I don't know Robinhood's yet. But once you get to that mark, you need to spread out your money. You need new investing accounts, new banks. Once you max out those insurance amounts, you're gonna have to spread that money amount, and then eventually you're gonna need a place to store your value. You have millions of dollars, so that's why property is so important, because you get insurance on property. It's easy. It's not like putting millions in stocks when you don't have insurance on your money. That sucks. So property, businesses, these things become important, much more important once you're at the once you pass 500K. Anyways, that's all I'm going to talk about that. If you guys like this video, smash that subscribe button, hit that like button. Let me know what you guys think about this video and if I helped you guys out. And be fearful when others are greedy, and be greedy when others are fearful, by billionaire Warren Buffett. And essentially what this means is when traders are greedy, they'll keep on buying and driving the price up and thinking that it's going to keep on going up and up and up. But eventually what ends up happening is the stock ends up tumbling back down to earth from the moon because of greed. And people, that's how people lose a lot of money. And when Warren Buffett says be greedy when others are fearful, what he means is that when others are fearful because the stock plummets and everyone starts selling their stocks at a discount, that's the time you want to start buying companies. That's the right time to buy. But usually people start selling. People call it a crash, and that word crash scares people. Really? Let's change the definition. Instead of crash, let's call it a discount. That's essentially what it is. A discount. That's really what it's all about. So as we can see, the Fear and Greed Index by CNN, what emotion is driving the market right now? What emotion? Right now, the greed is driving the market right now. And the reason for that is, as we can see, the McKellen Volume Summarization Index measures advancing and declining volume on the New York Stock Exchange. During the last month, approximately 8.23% more of each day's volume has traded in advancing issues. then in declining issues, pushing this indicator forward the upper end of its range for the last 2 years. And as we can see, the stock price strength, that was the breadth. With the stock price strength, the number of stocks hitting 52 weeks highs exceeds the number of hitting lows and is at the upper end of its range, indicating extreme greed. As we can see, that's why the market kept going back up and up. As we can see, it's in the greed territory. As we can look at the safe haven demand, the difference in 20-day stock and bond returns, stock have outperformed bonds by 2.92 percentage points during the last 20 trading days. This is close to the strongest performance of stocks relative to bonds in the past 2 years, and indicates investors and rotating with stocks from the relative safety of bonds. And when we look at the put and call options, the CBOE 5-day average, the put-call ratio during the last 5 trading days, volume and put options has lagged volume in call options by 36.82%, as investors make bullish bets in their portfolios. However, this is among the lowest levels of put buying seen during the last 2 years, indicating greed on the part of investors. And when we look at the market volatility, the VIX and its 50-day moving average, the CBOE volatility index is at 15.72. This is neutral reading and indicates the market risks appears low. And when we look at the junk bond market, the yield spread between junk bonds versus the investment grades, investors in low quality junk bonds are accepting 1.74 percentage points in additional yield over safer investment grade corporate bonds. This spread is much higher than what has been typical during the last 2 years, and indicates that investors are highly risk averse. When we look at the market momentum, the S&P 500 and its 125-day moving average, the S&P 500 is 1.04% below its 125-day moving average. During the last 2 years, the S&P 500 has typically been above this average. So rapidly declines like this indicate extreme levels of fear. So as we can see, the greed index right here, the greed over time, we are hitting the peaks. We are heading towards the peak greed moments. However, that being said, we still have more greed to go. So if you're heavily invested, this might be the time to get prepared for a downfall. As we can see, that way when you have cash at hand during times of extreme greed, extreme fear, you can buy stocks and from good companies at discounts. When we look at VictorVest Stock Advisory says that in the short term, the market is mildly bullish. Victor Vest advocates buying safe, undervalued stocks that are rising in price at this time. Second goal is to turn my 100 million into 100 billion. Like this video, leave a comment on the company or stock that you want me to analyze. I go over graphs, charts, news, quotes, forecasting, prices, rating, and reviews. My job is to help you pick the best companies and stocks to invest in so you can become a multi-millionaire. That's multi-millionaire like me. Subscribe so you can become a millionaire, and share this video to help your friend become a millionaire too. Don't miss out. Stay on top of your game and ahead of the curve. The world is your oyster. Make hay while the sun is shining. Everyone is subscribing to my channel, so subscribe so you can stay ahead of the curve, so you can come to my show, so you can flow. Comment down below so we both can grow. Like and share this video so everyone can know how to make millions of dough. Subscribe so we both can thrive. Join the millionaire tribe. Watch this video until the end to win the grand prize. It's show. Turn my 100 million into 100 billion. Like this video, leave a comment on the company or stock that you want me to analyze. I go over graphs, charts, news, quotes, forecasting, prices, rating, and reviews. My job is to help you pick the best companies and stocks to invest in so you can become a multi-millionaire. That's multi-millionaire like me. Subscribe so you can become a millionaire, and share this video to help your friend become a millionaire too. Don't miss out. Stay on top of your game and ahead of the curve. The world is your oyster. Make hay while the sun is shining. Everyone is subscribing to my channel, so subscribe so you can stay ahead of the curve, so you can come to my show, so you can flow. Comment down below so we both can grow. Like and share this video so everyone can know how to make millions of dough. Subscribe so we both can thrive. Join the millionaire. My link below for a chance to win $1,000 on my Webull account. And if you want a chance to win $25, make sure you download the app using my link in the description below. Subscribe to my channel so I can go over more news, more companies, and more stocks. I'll cover the earnings per share, the charts, the trends, the ratings, the news, the Sortino ratio and Sharpe ratio, market correlation, PE ratio, cash flow, balance statements, net assets and liabilities, and many more. Just for watching this video, I'm going to give you the chance of winning the grand prize. For your chance to win, subscribe to this channel and comment down below, future millionaire. That's what you want to write in the comments below. Write future millionaire. For every social media website you share this video, it will increase your chance of winning the grand prize. Share this video on Twitter, Instagram, Facebook, Snapchat, to all your social media accounts to increase your chance of winning the grand prize. Congratulations. Don't forget to